So right now, institutional investors are sitting on this massive self-reported appetite of over $100 billion earmarks to basically save the planet,
Yeah.
but they literally cannot deploy the majority of it.
Yeah, it's pretty wild.
Right. And the reason is that the people restoring the ecosystems, the people financing the climate transition, refuse to use the same accounting math.
Exactly.
So today's deep dive is about what happens when those two isolated worlds are finally forced into the same room.
Yeah.
We're looking at a paradigm shift where the language of global finance is, aggressively changing to merge climate and nature together.
Even if the actual bank accounts are struggling to catch up. I mean, the friction from that collision is the defining story in institutional finance right now.
For sure.
For decades, the global market has treated carbon mitigation and biodiversity as separate ledgers. You have a climate window over here, a nature window over there. But the science, and increasingly the risk models, are screaming that this separation is just mathematically incoherent.
To understand how practitioners are actively trying to fix this, we are pulling from a really fascinating stack of sources today. We have the latest NBS Praxis weekly briefing dated today, June 27th, 2026.
Plus a landmark 2025 study out of Nature Communications.
Yes. And we're also unpacking some incredibly fresh, highly technical methodology reports from the United Nations Environment Program Finance Initiative, or UNEP FI.
Those are the ones that really get into the weeds of the math.
Right. So the mission here for this deep dive is to explain exactly how a project developer on the ground can combine climate and nature goals into one integrated project account. And we want to decode what global investors actually need to see on a term sheet to start writing checks.
Because it requires a fundamental rewiring of how we view assets.
Okay, let's unpack this.
Yeah.
Because to really understand the absurdity of the current system,
Yeah.
imagine you are trying to build a massive commercial high-rise.
Oh.
You hire one crew to pour the concrete foundation and another crew to build the structural steel frame. But the foundation team only accepts payment in euros, the steel team only invoices in yen, and your primary lender insists on issuing the loan in like a proprietary corporate crypto token.
That is a total nightmare.
It is. You are trying to finance one single structurally interdependent building, but the capital is fragmented into completely incompatible currencies. It guarantees inefficiencies, delays, and a high probability the building never actually gets finished.
That captures the structural bottleneck perfectly. I mean, we are trying to stabilize the planet's climate, the foundation, and protect its biosphere, the structural frame, using completely separate financial methodologies.
Right.
What the NBS Praxis briefing highlights is that this week, at the highest levels of global governance, there is finally a formal recognition that this has to be financed as one integrated structure.
Paid for in one unified language. And that recognition came straight from the top. On June 23rd, during the London Climate Action Week, the UN Secretary General gave a special address.
Right, the tale of two crises speech.
Exactly, climate and energy. But the massive shift was that he emphatically named halting deforestation and restoring nature as core climate responses.
Not just a side project, but core.
Yes. He took nature out of that peripheral philanthropic bucket and placed it squarely in the center of the urgent climate response strategy.
And when a head of system gives a speech like that, it totally alters the framing that ministries use to draft policy. The UN Secretary General essentially stated that saving the trees is the climate strategy.
You cannot achieve the necessary carbon mitigation without the biosphere intact.
Right. It elevates nature from a, nice-to-have corporate social responsibility initiative to a hard macroeconomic necessity.
But here is the catch. The actual concrete mechanisms the new initiatives announced in that very same speech did not go to nature.
No, they didn't.
They went to a new initiative tracking the environmental footprint of artificial intelligence and a call to action on methane emissions.
Which is incredibly telling.
Right. Nature won the beautiful sentences, but methane and AI won the actual bureaucratic machinery.
That contradiction is the defining story of the week. The integration of climate and nature is winning the narrative war, but it is lagging severely on the actual financial ledger. The NBS Praxis briefing describes this as one agenda, two speeds.
One agenda, two speeds. I like that.
Yeah. The high-level framing is moving at lightning speed, but underneath that rhetorical umbrella, the money is still flowing through clunky, isolated channels.
Wait a second, though. If we look at the financial estimates, for instance, the 2024 Morgan Stanley Capital International Primer, They reported that private finance for nature grew from roughly $9 billion to over $102 billion in just 4 years.
What's fascinating here is that figure itself.
Right, because if the private finance appetite has grown to over $100 billion, why are we saying the money isn't flowing?
Because we have to look at the composition of that $102 billion figure. It is a compilation of self-reported, heterogeneous instruments.
Like green bonds and things.
Exactly. Green bonds, sustainability-linked loans, private equity allocations, all using completely different taxonomies. It is not independently audited, deeply integrated capital flowing into a unified system.
It's just a measure of appetite.
Right. Institutional investors desperately want to fund nature, but to shift from a theoretical allocation to disbursed capital, those investors need preconditions. They need a standardized pricing mechanism.
Because you cannot have a liquid market without a universal way to price the asset.
Exactly. Which means we need to look at the infrastructure of pricing, the financial plumbing, so to speak.
And this week in London, the blueprint for that plumbing actually emerged at the 19th edition of the UNEP FI Global Roundtable.
Under the theme, From Risk to Resilience.
Yes. And what they presented in their insurance session was a first-of-its-kind methodology for integrating nature directly into climate risk underwriting.
Which is huge. And this was alongside new sector guidance from the Task Force on Nature-Related Financial Disclosures, or TNFD.
Right. And simultaneously, over at the EU Green Week events in Athens and Brussels, policymakers were successfully arguing that nature expenditure belongs in core public treasury budgets.
Not just isolated environmental funds.
Exactly. So we have the insurers rewriting their risk models and the treasuries rewriting their fiscal lines. Here's where it gets really interesting for you as a listener.
Oh, the seawall analogy.
Yes, let's visualize what this underwriting methodology actually does in the real world. Let's say you are a massive global insurance company underwriting a coastal city. Normally, you calculate the probabilistic risk of a Category 5 hurricane hitting that city.
And you set the insurance premiums based on the expected catastrophic loss.
Right. Now, if that city spends $50 million building a massive concrete seawall, the insurer runs the math on how much flood damage that concrete prevents, and they lower the city's premiums. The concrete is priced as literal risk reduction.
Right. But what the new UNEP FI methodology does is allow that underwriter to look at a mangrove forest, a complex living ecosystem, and price it with the exact same rigorous mathematics as the concrete seawall.
It transitions the mangrove from a qualitative ESG metric to a quantitative variable in a probable maximum loss model.
Which is a massive shift.
But wait, how does the math actually work to equate a living ecosystem to a concrete wall? I mean, a seawall is static, right? A forest changes.
It comes down to hydrodynamics and translating physical resistance into financial metrics.
Okay.
The new methodologies allow catastrophe modelers to input the specific roughness coefficient of a mangrove forest. They calculate the density of the roots and trunks and measure how much physical drag that ecosystem exerts on a storm surge.
Wow.
Yeah, they can mathematically prove that a healthy 500-meter stretch of mangroves reduces wave height by a specific percentage before it hits the urban infrastructure.
And that reduced wave height translates directly to lower annualized loss expectancies.
Exactly. By running those hydrodynamic models, the insurer stops treating the mangrove as a charity donation and starts treating it as a hard, yield-generating financial asset that actively depresses risk premiums.
That is incredible. So, to synthesize why this matters for you, to shift from rhetoric to funding, institutional investors need pricing preconditions.
A national treasury that budgets nature on a core fiscal line, and an insurance company that prices nature in a risk model are the two ultimate buyers that this new integrated approach is trying to reach.
Give an insurer the infrastructure to price a mangrove as risk reduction, and you create the precondition for a massive financial instrument.
Yes, exactly.
But you can't insure a methodology. You have to insure a physical asset. If the models are being built in London and Brussels, where are the actual physical assets that can absorb this kind of institutional capital?
Well, that brings us to the physical reality in Southeast Asia.
Right, we are moving from theory to reality.
Exactly. This connects to the 2025 Nature Communications Study led by the National University of Singapore, Nanyang Technological University, and James Cook University.
They analyzed the specific ecosystems of the Association of Southeast Asian Nations, or ASEAN.
And the numbers they publish completely alter the value proposition of the region.
The data is striking. They found that conserving and restoring Southeast Asia's peat swamp forests and mangroves could mitigate roughly 770 million tons of carbon dioxide equivalent a year.
770 mTCO2, that is massive.
It mitigates more than half of the entire region's land use carbon emissions.
And the efficiency is the key metric for institutional capital here. These ecosystems are achieving that mitigation profile while covering only about 5% of the region's land surface.
That's just 5%.
Yeah. The carbon density in a peat swamp forest is orders of magnitude higher than a standard terrestrial forest.
Because the carbon is locked in deep, waterlogged soils, right?
Yeah.
Not just the above-ground biomass.
Exactly. It is incredibly dense.
So these physical assets perfectly deliver exactly what the London rhetoric described. They deliver mitigation, or carbon, coastal adaptation, which is risk reduction, and biodiversity all at once.
It is the holy trinity of the climate-nature nexus, all stacked in one geographic footprint.
But here's my question. If Southeast Asia has the literal golden ticket, these incredible nexus assets, why was all the marquee attention, budget line financing, and underwriting methodology focused on European and global convenings?
If we connect this to the bigger picture, having the physical asset isn't enough. The region was left out of the marquee rooms because the hurdle is no longer the science.
We know the hydrodynamics of the mangroves work.
Right, the science is settled. The hurdle is governance, standardization, and accounting. Southeast Asian projects must demonstrate their value in a language global investors understand. A project developer out there must translate their peatlands into the specific syntax that a London insurer and a global treasury can ingest into their models.
They need a ledger that speaks both nature and climate simultaneously.
Which brings us to the ultimate practitioner's test. How do you actually document a living forest so it survives the due diligence of a global underwriter?
Right.
The MBS Praxis briefing provides the actionable blueprint for building this integrated ledger.
So walk us through this blueprint. If I am a project developer staring at a degraded mangrove forest in Southeast Asia, how do I actually structure this unified account?
The first non-negotiable instruction is an immediate change in origin strategy. Stop presenting a project as either a carbon asset or a biodiversity asset.
The days of siloed pitching are over.
Completely over. You can't approach a buyer and say, we have a carbon credit project that generates verified emission reductions, and as a co-benefit, we protect some endangered species.
Right. Global capital will no longer pay a premium for qualitative co-benefits.
Because qualitative co-benefits can't be plugged into a probable maximum loss model.
They need hard numbers.
Precisely. The blueprint mandates that a single project schematic must feed into one combined account that resolves into 3 simultaneous, rigorously measurable outputs.
Okay, what is the first output?
First is mitigation. The atmospheric carbon you are sequestering or avoiding, measured against strict baseline methodologies to account for leakage and permanence.
Got it. And the second?
Second is adaptation, the literal physical risk reduction that the insurer can run through their catastrophe models.
Like the wave drag we talked about.
Exactly. And third is biodiversity, a documented uplift in ecological integrity measured using standardized biodiversity metrics like mean species abundance or acoustic monitoring.
So what does this all mean when you actually take it to a financial institution? What does that look like on a term sheet?
Well, this raises an important question about how we stack yields. On the term sheet, the mitigation output, the carbon, often provides the primary cash flow.
The direct yield.
Right. The adaptation output, the risk reduction, provides the risk floor.
Which lowers the cost of capital or reduces the insurance premiums on the underlying asset.
Exactly. And the biodiversity output provides the integrity premium. It satisfies the strict regulatory compliance requirements that sovereign wealth funds and massive asset managers now face under frameworks like the TNFD.
But a spreadsheet generated by a project developer, no matter how rigorous the local math is, won't survive institutional due diligence on its own right.
No, it cannot exist in a vacuum. The outcomes must be anchored in national policy.
So it has to tie into a country's nationally determined contributions, their NDCs and National Adaptation Plans, or NAPs.
Right. Institutional investors require evidence that the project has governmental legitimacy. If you can prove your integrated ledger actively helps the host nation meet its sovereign treaty obligations, the project's bankability skyrockets.
Because the regulatory risk plummets.
Exactly. The investor needs to see that the host government has a vested macroeconomic interest in the project surviving for the next 30 years.
That alignment is the final piece of evidence required to unlock the account.
The field now has the language and the methodology. The scarce skill in the market is no longer structuring a single bankable asset. It's positioning a project, so its climate and nature value are legible on one ledger.
So the actual disbursed capital, that $100 billion of pent-up appetite, will flow to whoever successfully writes this integrated account first.
Exactly. The practitioners who can translate the complex hydrodynamics of a swamp into the strict actuarial math of an insurer, while aligning with sovereign NDCs, they hold the keys.
To recap the journey today, we went from the UN podium's lofty rhetoric elevating nature to the core of climate strategy.
To the new UNEP FI underwriting methodologies, pricing mangroves as financial risk reduction.
Right. And then we looked at the physical proof of concept in the incredibly carbon-dense peatlands of Southeast Asia.
And finally, the strict three-part accounting checklist required to unlock that global capital.
It is a race to build the first perfectly integrated ledger. And if you look at the calendar for the upcoming months, it is packed with massive convenings.
It really is. The Nature-Based Solutions Symposium in York, focusing on benefit sharing.
Climate Week in New York City, dominated by corporate target setting.
And the NBS Congress in Paris, focusing heavily on advancing monitoring and standardization.
They will all be debating governance and the integration of these massive frameworks. But I want to leave you with a final thought to mull over. What if the breakthrough doesn't come from a massive global institution making a grand pledge at one of these conferences?
What if the first perfectly integrated, fully financed climate-nature instrument is quietly structured by a local practitioner on the ground in Southeast Asia?
Exactly. Someone who looks at the mangroves, simply bypasses the global rhetoric, applies the UNEP FI methodology directly to their local asset, and writes the unified ledger first.
Because the capital is just waiting for the math to make sense.
It's just sitting there waiting. Thank you so much for joining us on this deep dive. Keep looking for the connections between the big ideas and the bottom line, and we will catch you next time.